Hi everybody, this is Seth Martin and welcome to Middle Class Investor. It is June 16th, Father's Day. So if you're a father out there, happy Father's Day. I had a good Father's Day. Kids gave me some nice cards and we had a good time and cooked hamburgers and stuff like that. All right, so getting right into it, we're looking at the equity market here as represented by the S&P 500. I moved this little oval here was a little further over, like in August, and I moved it over here to mid-July because I don't think this is going to take as long to get up here. We do a little speculating from time to time on here, and I want to do a little bit today because I want to just talk about what could happen here. This could, this could pull back a little bit and then kind of make its way up to here, pull back again, and then like that. So this could take, a month, probably not more than a month to get here. That's why I moved it to mid-July. Mid-July would be about a month from now. But then the more important thing is once we get to this area here, I'm expecting, the market to drift back all the way down here in a wave E. So, and then that would complete wave 4. Wave 4 is this expanding triangle between these two dashed red lines. So I'm going to put a 4 there. Do like that, and I don't know what this is. I'm going to delete it. Delete that. Oh, I deleted the wrong thing. Hello. Let me delete this, and then put a 4 there, because we're expecting 4 to come down into this area. Let me get that arrow off. That's under hide arrow. There we go. And so I'm expecting this to come down in complete 4 with a wave E. So let me put an E there. So this will be wave E of 4. So let me hide the arrow again. Oops, there we go. So this will be wave E of 4, and then if this is what it turns out to be, then of course we're going to have a 5 up, and it'll make new all-time highs up here. So we're going to get a new all-time high here. We're going to sell off probably, and then rally back up probably into the election, and then reach a new all-time high. And whatever happens in the election, I don't know why it would be this way, but it doesn't. At this point, it doesn't matter who wins. If Trump wins, or if the Democrat wins, it looks like the market is going to want to sell off. So let me just zoom out and let's kind of map this out as to what it might look like. So let's do a monthly. Let's do a quarterly chart. It's not giving me enough room here. Let me go back to, let me do a weekly. Go back to weekly, and then I'm going to create a little bit more space here to work with, so that we can speculate a little bit as to what this is going to look like. So you can see I created some more white space out here. So I just want to draw a little bit and see what this might do over the next 2 years. And I know it's kind of hard to believe. I mean, of course, I thought we topped back here, right? But it's hard to believe this is going to last another 2 years. But that's kind of what the chart is saying. So we got to kind of. I forgot who said it, but somebody said one of the hardest things to believe is what you see. So I guess that's this particular kind of case. So what we're expecting is wave E to come down and kind of finish here. And then what we'll get is we'll get some sort of wave 1 up, wave 2 pullback, wave 3 up, wave 4 pullback, and then a wave 5 to a new all-time high, probably around this 3,200, maybe even 3,250, somewhere around in here. And then we're going to start the mother of all sell-offs. And so I don't know. It's going to be an interesting time, and I'm this is really speculative and it's hard to say. But let's say the market tops at 3,200. We could be looking at hold on, 3,200. What I want to do is I want to do like a point times, okay, 320. So again, let me back out again, because this is going to be a shocking kind of revelation here. Let me put 20 years on this. That's not even enough. Let's just put all data. So what we've got here is we've got 5 waves that go all the way back to the 1975 bear market low. And so we got a wave 1, a 2, I'm sorry, 1. Well, it's hard to see what it is here, but this was the end of 3. So somewhere in here there was a 2, maybe right here in 87. So 1 up to 1987, 2, and then 3 up to here, and then, like I said, 4, and then a 5. And so once this 5 wave, this last, not the 5 wave we just talked about, but this last 5, which is extended, once it pulls back, we're coming to here, which is 500 on the S&P 500, which is, that's a little bit hard to believe. And some people think even lower, maybe as low as somewhere between maybe all the way back to the 87 low, which is, I can't even tell what that is right there, but it's somewhere around 200. So these are I don't know, it's difficult stuff to believe, but what we know about the wave principle is that the entire move is generally retraced once we break through wave 4. So if we were to break significantly below this blue box here, then what the wave principle is telling us is that we would trace this wave 3 all the way back into wave 1, which is kind of this 1979, 1980 area, which is a pretty low number. So I don't know. I mean, that's what the principle says. Is it actually that? It's hard to say. Also, this is the previous wave 4 is the 1970s bear market, right? Which is right here, which oddly enough is another expanding triangle. So there's a saying about history that history doesn't repeat itself, but it rhymes. And it's just kind of interesting here that we have this A, B, C, D, E to complete a 4. So this was a 4. Put the 4 there. It was just a 4 of a different degree of trend. It was E of 4. So again, A, B, C, D, E, 4. And then this whole thing, this whole last part was 5, with this last thing being 4 and then 5. So kind of a 1, A, B, C, 2, 3 up to here, 4, and 5. So when this final 5th wave is complete, the first move will be back down to here. So, around, I don't know, around 700 or so, below 6, whatever this low was here, I can't remember, it's like 650 or something. So probably 575, 600. And then we'll rally a little bit, maybe up to, I don't know, 1250 or so, and then roll back over and sell off, and could go all the way down here to 1974 bear market low. And that is something that's going to be something to behold if that actually happens. I hope it doesn't happen, but I think the stage is set with the corruption in our money system, and the fact that we're not backed by anything, and who knows? We'll see. Certainly my goal here with this program is just to raise the possibility, mainly so that you don't have in your mind that that's somehow impossible, that there's just no way that could happen. And I can just tell you, let's go back to the all data. People that lived during this time right here, this right, let's just talk about right here. Let's say this could actually be very similar, actually. So this is like a run up into a completed wave 5. This was A down, we had B up, and then look how far C fell. And people said to themselves, I can't go all the way down there. That's impossible. Where the market is concerned, nothing is impossible. So here we are. It bottomed in June, sometime in June of 1932. So let's just look real quick and just see what that is. From here down to here. So we have an A, B, C, which is a corrective move. Let's just measure that real quick. Let's just go. Some of you have seen me do this before, but let's go from here down to this June low. And what we can see, I'm gonna get your eyes to come to it, but look right up here where it says percent change. Watch what it says when I get to the June low. June low is right there. It's minus 86.2%. Now, believe me when I tell you that there were people all along in here that did not think that it was possible to go that far back. Okay, that's always the case. A good way to see all this data is go to the DJIA, which is the Dow. Whoops. Or maybe it's. Let's see. I've got it in here. I can't remember what that. I never go to that one, so I can't remember what it is. Oh, the INDU. So you can see what happened here is the market in between the 20s, well, just the whole decade of the 20s, had this really steep run up right up here, and this was unprecedented. By the way, this was it doesn't look like it on the chart today, but from this low right here up to here, again, keep your eyes on this area right here where it says percent change. Look at that. That was a 500% move from this 1921 low all the way up here to the 1929 high was 500%. That is a huge, huge move in 8 years. Okay, that's basically what that was, 8 years. Okay, so let's just see what ours was from here, from this low here up to the high today. Golly, I'm going to have to zoom in a little bit more because I can't. Yeah, there we go. So again, keep your eyes up here. We're on the percent change when I move it. So we go from the low. So from the low to the high. The high so far has been right here, about right there. That's 300%. And we're probably going, like I said earlier, well, I was talking about the S&P 500, but probably to here, 340%. So this isn't even as crazy of a move as we had in the 1920s. So, but having said that, the fractal move, in other words, we're not comparing apples to apples there. If you wanted to compare apples to apples, you would measure from this 1974 low up to the current high, and that's the next degree trend higher move. So if you measure that, it's much larger than 500%. It's let's see what it is. From here to somewhere up here, let's say, what is that? That's 28,000. Let's go to 20. Let's finish out at 30,000 basically. So from that low to 30,000, you can see there is 5,000%, which makes sense, right? It's a degree. It's an entire degree of trend greater So 5,000% makes, a lot of sense when the other one was 500%. So is it possible? Yes. Is it going to happen? I have no idea. But, we just have to be prepared. I mean, if we significantly break through this low, I mean, if we come down pretty hard and we don't really stop until we get, right here and I know this is not helping that much, when we get to 3,800, then what's going to happen is we're going to have a rally, and we would definitely at least come all the way back to the 87 low, which would be about right here, which is about 1450. So I just want to prepare you. Again, it sounds crazy, I know, but if you really look into this, one of the problems with human nature is you can't imagine something could possibly happen until it actually happens. And then people start talking about how obvious it was. And usually when somebody, talks about how obvious something is, they're obviously wrong. So things just aren't as easy to spot, especially if you don't have the mental framework for it. If you don't have a belief system that says that anything can happen. So anyway, we've spent a lot of time on this. I'm going to go back to a 5-year chart and start looking at some of the other things we've got here. I know a lot of you are interested in the treasury. I'm going to go back to the log scale, and we've on a weekly chart. Let me take the log scale off. So we one of the things that's happened here that we need to point out is that the interest rate broke out of this channel that's been going on for a long time. So since November of last year, so we've been trading in this channel. All of a sudden, last 2 weeks we broke out of this channel, and it doesn't look like it's finished yet. It might rally a little bit this week, and then maybe fall and make a new low. But what I would say, let's go to the 10-year and we'll look at the 30-year too. We've talked about some of these levels. We've got this level sitting here around 1.9. I don't know. I said weeks ago now that I don't know how many weeks ago. Once it broke down below this yellow box, we started talking about, okay, once it rolls back over, we're probably coming down to this level. And I talked about a target of around 1.9%. Could be slightly lower, could be 1.85. If you look at I pulled up the wrong thing. The 30-year treasury, same kind of deal. We've got some pretty good support in this area around 2.4. So, and in the 30-year could actually trade a little bit sideways here for a while and then make a new low. So again, I like to look at the 10-year because the 10-year is really the most important interest rate in the market. It's not the Fed funds rate, it's the 10-year treasury. So that's why I like to look at that. All right, let's look at volatility. Volatility continues to fall in this area. We had this spike, which had me thinking, okay, well, this is things topping, but then volatility moderated again. It just it just doesn't go, the market just doesn't go straight down. It doesn't go straight up. It weaves and bobs, and it's very frustrating thing to try to make money with on a consistent basis, like week to week, month to month. That's why so many people are buy and hold people, is because it'll just drive you crazy almost trying to pick the next 10 points or so. All right, so here's Germany, and we said a couple weeks ago it looked like Germany was rolling back over. We might get a little ABC, and then Germany probably, if it does sell off, it's probably going to stop somewhere around here, around 23.5. So keep an eye on that. Japan, Japan's chart looks If I can get it to come up. Looks similar, you know, same kind of thing. We look for some sort of correction here, and then Japan to come down to here, rally, and then sell off again. So it looks like these are all rolling over. There was a time when I thought maybe UK might lead us out of this, but I don't know. It doesn't look like that's going to be the case. I'm looking for the UK to work its way down into this area. So that's what I see with those charts. Let's go to it's the euro. I think I mentioned last week or the week. I guess I wasn't in here last week. So the week before last week, I mentioned that the euro might have one more low in it, and that could still be the case. Although I will tell you, for me personally, what I'm going to do, and of course you need to do what you're going to do, but what I'm going to do, I'm just telling you, is I think this is going to kind of weave up here a little bit, and then when it makes a new low below this low, somewhere in here, and then looks like it starts to bounce, I'm gonna enter right there. I'm going to enter right there. I may wait for let me just show you what I may do. What I may do is I think probably this week, at least the beginning of the week, we could have a situation like this where it kind of does this and runs up a little bit, and then turns around and sells off, okay, and ends up making a low below this low, and then we might get something like so, where it's kind of inside. And this is called a bullish harami. So if we get something like this, and then we get, let's say, a close above this high, not necessarily this high, but this high, because once we get a harami, once we get a low, and then we get an inside week, if we get a close above this inside week, for me that's going to be an entry. Okay, that's going to be an entry. And then what I'll do is I'll have my stop down here somewhere. So a few weeks ago, we talked about this trade, and we were talking about how, if you figure the math out on this, let's say you want to set your stop at 1.109. So let's just put those numbers in, 1.109. Okay, and let's just say our entry, just guessing, is going to be, I don't know, 1.124. 1.124. Okay, that's 150 pips. So let's just say we were going to trade 100,000, a full lot. That'd be $1,500. So we'd be taking $1,500 of risk, and that's if we put our stop back here. If you put your stop below here, obviously you're not going to be taking $1,500 risk. But let's just say we put our stop down here around 1.109. Okay, so let me just mark this on here with a couple of lines. So let's say our entry was like right here, and our stop was right here. Okay, so that's our risk. Okay, yeah, I didn't do that right, but you get the idea. Let me move this up so in case you're coming back and looking at this recording later. 1.1095, let's say. Okay, and then we talked about our target. Well, your first target is going to be right here around 1.1275. Let's say 1.1275. So if I enter here at 1.1243, okay, and I go to 1.1275 minus 1.1243. This is not what I want to do. This is not giving you the right information. Well, just visually, I mean, look at these. Look at the risk, the reward versus risk. Okay, so I'm going to scrunch this in a little bit, and the risk is here from here to here, right? You enter here, you're out here, okay? And the reward is up here. Oh, I know, I was doing 1.125. It's 1.256. 1.256, enter. 1.24 minus, and let's say we 100,000. Something is still not right about that, so let me do the math on that again. 1.124, enter. 1.109 minus 100,000 is 1,500, right? Yep, that's 1,500. But then from here to here is also 15, or yeah, from here to here, that can't be 1,500, that's more. So 1.256, 1.256 minus 1.124. Ah, that's different. Okay, now I got different. Now I got the right math. 100,000 is 13,200. So if we entered here, put a stop here, and put our target up here, just above this swing high, that's a $13,200 profit with about a $1,400 potential risk. So if we divide 1,400 into that number, that's about a 9.4 reward to risk. That is a good trade right there. So, you know, look, if you don't feel comfortable with it, you don't feel comfortable with it. But maybe you don't feel comfortable with a $1,400 loss. Well, then only do 50,000. Don't do 100,000. Do 50,000, and that would drop your potential loss to 700. If you don't feel comfortable with that, cut it in half again. Do 25,000, and then that would cut your potential loss to 350. But if you had a 350, would you risk $350 to make 33.25? You know, 3,325. I think that's a good reward to risk. And I mean, these don't come along very often. And what you could do is once it gets there, let it pull back in kind of an ABC, and then re-enter, you know, right here and go for the really long target, really long-term target, which is up here around 1.6239. And now you're talking about really big bucks. So I would encourage you to look at the euro. It's your money. You decide. You do what you want. You know, this is not advice. You know, that kind of stuff. You know, that whole disclosure thing. You know, without me knowing you personally, it's hard to know what you should be doing. But I'm just showing you what I'm doing, and I'm showing you kind of the methodology behind it. What you actually do and the amount of money you put at risk is really your decision, and really it's only your decision, because nobody can sit in the seat for you. Nobody can do this for you. You know, if you want to learn how to invest your own money, you're gonna have to do it. There's just no way around it. All right. So I'm gonna look at oil real quick. You know, oil continues to pull back. We had talked about potentially it pulling back into this area around 35, and it looks like it's, you know, that's where it's going to want to go. I suppose we could get a little rally up into, you know, the 58 area, maybe even as high as 60, but then I expect this to roll back down and continue this move into this area below 40, let's say. All right, that's oil. Let's look at, what else can we look at? Let's look at gold and silver. Let's just look at gold. GC, gold contract. And what you can see is we didn't quite, I mean, this is real, I hate when this happens, when you have this box here and you're trying to get, you know, this is the problem with trying to get every little inch out of a trade. You can see it didn't, and this is a great example of what I was telling you, that this box is just an area, it's just an arbitrary area. It's not something you should put, you know, a lot of emphasis on. It's just an area to remind you where you expect the market to go to. What would have been more productive here would be to identify the low week, which is this one. Okay. And do we get a close above the low week here? Nope. Do we get a close above the low week here? Nope. Do we get a close above the low week here? Nope. Do we get one here? Yes. So we got a close above the low week here. So really the best you could have done was entered here at around 13.12. And the bottom line is the reward to risk is not that great on gold right here, because we're not expecting. Well, I say that I didn't realize I was looking at this line, and that's not what we're looking at. We're looking at a trade up into this 1460 area. So probably what'll happen, you can kind of see it here. I'm gonna try to point something out, so you can, because really what I want to try to do is get used to seeing this kind of stuff on your own. But you can kind of see there's let me just draw them in here. Let's put some lines in here, so you can kind of see this could be like a 1, this could be like a 2 to this higher low, this could be like a 3, and then we had a 4 back to this low, and so I'm expecting to have say a 5 right there. Okay, now what do we know that happens after 5 waves? I mean, you can kind of see the 5 waves there, right? Well, we know that we're going to have a move in A back to the 4th wave low. We're probably going to have a rally in B, could be significant, and then we'll have a wave C down into this area. So what you could do is you could look at this area right here as an entry, okay? And now, so where would the stop be? Where would the stop be? Well, you would wait for the low of the high day kind of thing, and then you would put your stop below the low, okay? But where are we looking for this to go? Well, we're looking for this to go up here to this area around 1460. So we got a pretty decent move up here to 1460, maybe a little higher, maybe 1500. Okay, got a nice little move there. So and then we would have, let's say that's wave 3, and then we get some sort of wave 4 back down to here, and then up in wave 5. So 1500, 1550, something like that in gold. It's a good move. We'll just leave that on the chart so we can look at it next time, so it'll remind us what we're looking at. But you can see we've had this on the chart for some time. Of course, we got it taking a little longer, maybe into 2020. It's hard to say exactly, but who knows? Now the other possibility. Well, no, this is. So what happened here? Let's talk about this. Okay, so we had this come down in this low. Okay, and so this thing here was A, and then this A, B, C, D, E is B. So the end of B is here, and so what we're looking for is 5 waves. All right, so we got this wave 1, 2, 3, 4, 5. And once we have 5, it completes this whole A, B, C. So what do we know about that? We know we're at least coming back to here. Okay, $1,000. So what you could do, I mean, some of you might not want to be messing with this right now, but you could wait for this to come all the way back, and I think we've talked about where we think it's coming back to. It's probably coming back to this 4th wave low here. We've got this huge bull market run up. This looks like the wave 4. So, we've got A, B is going to be up in here. C is going to at least coming back down to the $1,000, and probably more likely coming down here to this 600 area, 700 area. So, the holy grail purchase of gold is going to be around that 700 area, and then, man, I just don't think you're ever going to see gold come back that far again. So what does this all mean? If gold is selling off, that means the dollar is what? Is it collapsing or is it rallying? No, it means the dollar's rallying. As gold comes down, normally that means the dollar's rallying. Okay, so what would be happening with oil? Oil would be going down as well. Okay, and then once it bottoms out and they start going up, what does that mean? That means the dollar's getting crushed. Okay, that means the euro is going to be going up, oil is going to be going up, gold's going to be going up. Anything anything you can buy that's priced in dollars, you're going to be, to short the dollar, you're going to want to buy things that are denominated. I mean, you're going to want to, buy things that are denominated in dollars, like gold, so much gold per dollar, and so much oil per barrel, so many dollars per barrel, so on and so forth. So that's the thesis. This is going to be the completion of the commodity deflationary move. Once we get back into this fourth wave low. In fact, let's just draw that on the screen here, so it'll be easier to monitor when it's coming. We're gonna have to wait until we get some more price out here, some more right-hand space, but let's just leave it there. Like I said, it'll be 2020, 2021, somewhere around there. C is going to take a good long time to develop. The good thing about C waves is they're almost always 5 waves. So what are we going to be looking for? We're going to be looking for a move that goes down. We're going to be looking for an A, B, C up. And then we're going to be looking for a 5-wave move down in 3, like so. And then we might be looking at like a triangle in wave 4, like so. I can click on it. There we go. That, and then wave 5 down to complete the move. So the cool thing about C waves is it's fairly easy. Now, sometimes let me tell you something here. Something that can sometimes happen in commodity markets. This is something that Robert Proctor teaches. For some reason, I can't. Sometimes the 5th wave can extend. So sometimes the 5th wave can be very long. It can do one of these numbers. Okay. So picking the bottom can be tricky, but what you can do is you can say, well, I'm just not even going to get interested in buying gold until I see some pattern that looks like this to the downside from this point. So something that goes from here down that looks like this. In fact, let's just leave that on the screen. Okay, it's another good thing to just leave on the screen. All right, I've been rambling a little bit. I didn't really have a plan when I came in today. But I think we're seeing. I think you can kind of see these moves. When I go back and I look at the S&P 500, for example. Let me pull that up. Sometimes you're looking at these charts and the picture just is not appearing. You just can't see it, and then at some point it appears. Like right here, it finally. Like it looks like this could be A, B, C, right? And then this is going to go up and make a 5th wave. But then you had this kind of a weird move where, I mean, it didn't look like 5 waves. So all of a sudden, okay, well, this could be wave D and E. My point is, it's just at some point the picture begins to appear, and then you can really lock in on quote unquote a forecast that puts you on the right side of the market and gives you an opportunity to win and win big. One of the benefits that you have as independent investors that don't have a lot of money, like you're not institutional money, is you can sit on the sidelines. You just sit on your hands and do nothing. This is a huge advantage in the market. But the institutional money guys can't do that because people. The people that they trade money for expect to have something every month. I mean, you can't win every month necessarily, but they want to see fluctuations. They expect to see fluctuations in their account. They just don't want to see holy cash, because their attitude is that, well, if all you're going to do is hold cash, I can do that. Well, that's true. So anyway, it's just a huge advantage you have in the market, and you should exercise that advantage. All right, everybody. I guess that's going to be it for this week. Again, what we're looking, just one final note here before we depart today, is we're expecting this to kind of make its way up here like so, and do something like maybe come down here in A, maybe make a B up, C for the completion of E4, and then bam, just all the way back up, new high, and then end of the bull market. So probably good, like I said, probably going to happen. This is going to happen into the run up to the election with like peak optimism. I mean, I can totally see, let's say Joe Biden or Bernie Sanders gets the nomination, and you just got peak optimism in the news. They're just foaming at the mouth over Bernie Sanders or Joe Biden is going to finally rescue us from Trump and blah, blah, blah. And then boom, Trump wins and the market just tanks. I mean, I could totally see a scenario like that. The good news would be that Trump would win. I'm not a huge fan of Trump, but I think these Democrats are absolutely crazy and they believe in fairies and magic, and I just don't think they're grounded in reality. So I think it would be worse if they won. But aside from that, I don't think they really have that much of an impact on the market. The bigger impact is the mood. What is the mood in the country? And I think the mood is going to be just really high going into the election. The expectation is going to be kind of like what happened with Hillary Clinton when she lost, right? We were like right in here somewhere. And, I honestly think had she won, we might not even get this pattern. This might have been, I don't know, we might have gotten kind of a move down to here and then a move up and then a sell-off. I mean, it could have been something completely different. I don't think we would have ever made new highs if Hillary Clinton had won. I just think everybody thought she was bad for the market. So anyway, we'll see. Okay, that's the fun thing. That's that's even more fun to speculate, right? That's what they do on the news every night and everybody's into it. It's a lot of fun. So we'll see what happens, and we'll go from there and come in next time, and we'll keep an eye out for us. All right, everybody. Thanks for coming in. We'll see you next week. Bye.